The demand for office space remained robust in the last quarter of 2016, reaching 154,000 square meters and pushing 2016 take-up to a total of 676,000 square meters. That is 7% higher than 2015. Supply, on the other hand, saw numerous delays, as completion totaled to only 500,000 square meters, which is significantly lower than the forecast earlier in the year, which was close to 900,000 square meters. This is primarily due to the lack of skilled laborers, and excluding the effects of construction delays in the fourth quarter of 2016, full-year demand would have grown by 15%. The market was still primarily driven by the IT BPM companies. Close to 60% of take-up across Metro Manila came from these companies. Non-BPO companies comprised 32%, while the balance came from offshore gaming companies. A total of 85,000 square meters of office space was taken up by offshore gaming companies in 2016, most of which came in the last quarter. This was a significant jump from a handful of deals recorded in the previous 2 years. Interestingly, the minimum volume take-up of these companies stands at 10,000 square meters. Take-up from non-BPO companies also continued in the market, primarily in the central business districts of Makati and Fort Bonifacio. Finance firms Metrobank, Home Credit, and Citibank, among others, also contributed significantly to the 2016 transactions. These are among the firms that moved to newer and more modern office spaces. 2016 also saw tenants show a growing preference for more modern and quality office space. The growth of tech companies mirrors this with the expansion of Google. The entry of IKEA through the growing flexible workspace market will also potentially dictate the workplace design preferences of the country's millennial workforce in the coming years. For 2017, these trends will continue driving demand. We project an 8% growth in 2017. This should keep overall vacancy low, which stands at just over 3% today. We predict that the current stock will increase by almost 900,000 square meters, which is 64% higher than last year's new additional supply. Despite this expected upcoming supply, we project vacancies to remain low, below 5%, due to the strong pre-leasing across submarkets. Buildings due to be completed within the year are already 32% pre-leased as of the start of 2017. Given current market dynamics, we expect rents to increase across the various submarkets. We recommend tenants to be quick to lock in deals, as offshore gaming companies are scrambling for sizable office space and securing them immediately with minimal negotiations.